Good morning. This is Rich Sierra with Business SOS. Today's episode is episode number 14. Top 10 tips to consider when you're buying a business. Today we're going to it's going to be a two-part series. And I'm going to give you kind of an outline for what you should consider when looking at due diligence when buying a business. Before I do, this is my birthday, so I want to wish myself a happy birthday. And a lot of people are doing that. But it's a birthday edition of Business SOS. So I'm very excited to share this day with you and this moment with you. Before I start, I want to thank the people at the Florida Hispanic American Chamber of Commerce in Palm Beach County. On Wednesday, I had the privilege to be their guest speaker. We talked about Business SOS, the 8 common legal mistakes business owners make and how to avoid them. That's my book. It's available on Amazon, Barnes & Noble, and also available in the local bookstores. You can ask for the book. But they were so gracious, and we had a good question and answer session. We signed books. They truly made me feel special, and I'm looking forward to becoming a member of the organization and being part of it because it was really a lot of fun. And that made me feel so welcome. And a special thanks to the founder of the organization, Santos Arroyo, and the current president, Juan Pagan, for inviting me to their home and to really making that evening so special. So I just want a big shout out to them and thank them for a great event. So today we're going to start. So you're considering buying a business. And as I've mentioned, perhaps in prior episodes, when you buy a business, it's different than buying a house. When you buy a house, there's some safeguards in place. Not necessarily safeguard, but there's a uniformity that goes with buying a property. You pretty much have the same forms that you use when you close in a business. You have a title company that makes sure that you have the proper title insurance. There's a lot of people involved in making sure that the transaction is correct. If there's a mortgage involved, the mortgage company is going to make sure that everything it is properly done in order to safeguard their interest, because you're basically placing the house as a collateral in order to receive the mortgage. So there's a lot of safeguarding in place to do that. When you're buying a business, it's not the case. When you're buying a business, you can buy a business with a one-page document. You can buy a business very informally, just downloading a form from the web, and you basically, somebody give you a bill of sale, you buy the business, and here you are. So there's no uniform standards on how to buy a business. There's no safeguards. So in my practice during the last 18 years, I've done a few hundred of these transactions, and I've also seen a lot of mistakes along the way that people do have made in order to save money. And I've seen people buy businesses just with very rudimentary agreements that in reality do not serve their interest, do not protect their interest. And then they come to my office, I bought this business. It's not really what the owner told me he was going to do, what the business was going to do. And, everybody left and I lost my investment. And I'm not talking here about investing $10,000 in the business, which is still a lot of money, but some of the people that I've spoken to and some of the mistakes that I've tried to resolve involves hundreds of thousands of dollars. And for whatever reason, maybe because familiarity with the seller and the buyer, maybe because they just wanted to save some money, they decided to do it on their own. And that's where problems lie. So, my first advice, if you're considering buying a business or selling a business, have legal counsel help you along the way. You'll have that safeguard, you'll have that protection, and that's what we do. We can help you, but at the same time, you'll have something that will give you peace of mind to make sure that everything is done properly, and you'll avoid some of the mistakes that many business owners make along the way. So let's get started. An important part of buying a business is due diligence. So what is due diligence? Due diligence is the process that you go of investigating every aspect of that business, and you do a deep dive into that business to make sure that what you're buying is basically is represent that what they're representing to you as a seller representing to you is close to or accurately represented and is supported by the documents that you're going to be requesting. So that investigation is very important. I suggest to have that investigation done through with an attorney, with your accountant, just to make sure that everything that they're sending to you, it is accurately represented, and you have an informed decision on whether or not to go with the transaction. So what is the process of buying a business? Usually people, some of the business owners that I've met that bought businesses, they go online, they look for businesses for sale, they're interested in buying a different type of business. Could be a retail business, could be a restaurant, could be a service business online. And then sometimes they find a business broker website. They have a listing for businesses for sale, and they find the listing similar where you find a real estate transaction, real estate property like a home, like a Zillow or Realtor.com. But they're websites specifically for businesses. So you see listings there similar to the way you see in property and home and residential properties. So, and you look at the business, looks interesting. You call the business broker, and the business broker say yes, still available. And the business broker gives you some information about the business, give you an NDA, and you say, okay, I want to get more information. And then you talk to the seller. You have some conversations. They tell you how much they're asking for the business. You agree to it. This is where the process begins. Usually, my preference is to have what is called a letter of intent first. Before any money is exchanged, before any commitment is made, a letter of intent simply is what it is. It means that it's simply, I'm intending to buy this business for this amount. These are the basic terms. What is the purchase price? How much you're going to have as a down payment through the due diligence process? How long will due diligence will be conducted? I like 30 to 45 days, depending on the business. Sometimes even more, depending how complex or large transaction is. It's going to be a cash transaction, or it's going to be a certain amount of financing. Whether it's going to be owner financed or it's going to be financed through the SBA, or it's going to be financed through a bank. All those key terms are there. When the transaction is expected to be closed, what contingencies are involved, whether it's going to be contingent on you as the buyer obtaining financing, or it's going to be contingent on a lease approval, which usually is a contingency that we include there. And it's also a third contingency that I include when I work on these transactions, is that it is contingent on a satisfactory due diligence at the buyer's sole and absolute discretion. And this is very important because you don't want to have a situation where you put some money down and then you find something in due diligence that you're not happy with. And then you have to go ahead and say, I want to get out of this deal. It's not really what I wanted to buy. And then find out that the down payment is not refundable. So my objective is this, is that if the deal's not going to happen, then you should get all your money back. You should have the right to investigate the business, with, following, doing your, with specific time period. But if you find something you don't like about the business, you should be able to get out of it, get your money back. That's the way I structure my deals. Everybody's different, but I like to structure them that way. After a letter of intent, then we'll move into the asset purchase agreement, which is really a longer document that talks more about the details of the transaction, what is included, and and when it's going to close, and what happens if you complete the due diligence process and you decide at the end you don't want to buy. What happens to that deposit? Most likely you will lose it because you completed due diligence. If you had to change your heart for whatever reason after the due diligence was completed, all those items will be included in that as a purchase agreement. And then we go into the closing, et cetera, et cetera. But today I want to give you the top 10 tips when buying a business. And again, this is going to be a two-part series. So today, this episode, I'm going to give you 5. The next episode, I'm going to give you 5 because it's a lot of material to cover. So the first thing that obviously you want to look at in the due diligence, and before I go further, remember, these are concepts. It's not considered legal advice. May apply or may not apply to your particular situation, but it will be helpful. So I hope this information is helpful to you. So, and this is 1 and 2. So I think that first thing we ask for the corporate records, and in Florida you can get information. So if you know the company name, so what I ask you to do, what I suggest you do, is to go to sunbiz.org. It's sunbiz.org, and look up the company. That'll give you the articles of incorporation. It'll give you the annual reports of the company for every year they've been in business. So you want to make sure the company is still active, whether it's an LLC, whether it's a Inc. You want to get that information. You can get it right off the web. So you talk to a business broker, ask them to give you the company name, because sometimes they are very cryptic about the company. They don't want to put the company name. Just have them to give it to you because it's public knowledge anyway. So at the very least, you get that. You begin to do your own due diligence before even committing to putting a price, putting money down. So once you get the articles of incorporation, you can ask for the shareholders agreement, if they have one, the bylaws. You want to make sure that the people who are selling the business are the people that appear in sunbiz.org. And if not, and who are the people that have the authority to sell this business? So at the very least, the company exists. We can go ahead and move forward. And it seems crazy to say the company exists. You'll be surprised how many businesses out there's nowhere to be found, and you have to ask more questions about where is this company located, where is it incorporated. I do need filed articles with the stamp of whatever state they're incorporated in to make sure that whoever is selling the business actually has the authority to sell it. Okay, so they should have that. There's a list of other items but right now, just basically the articles of incorporation, shareholders agreements, the last annual report. That'll tell you who the current officers of the company are. So just get that information. I will go then into the financials. That will be number 2. So number 1 will be the corporate records. Number 2 will be the financials. Financials is very broad. And when clients call my office and they say, okay, what did you receive? What type of due diligence have you done? I just got the tax returns and I'm okay with it. I'm like, it's not enough. And I'll tell you why. The tax returns it's important to have them because it tells you what the company is declaring as a profit, their revenue. And also you want to find out from the corporate tax returns who prepared them. Are they prepared by the owner of the business, or there's a CPA signing those returns? And that is significant because if a CPA is signing those returns, or an accounting firm is signing those returns or preparing those returns, you know that at least there's another pair of eyes that reviewed those tax returns, and very likely they're accurate for the most part, unless you go through an audit. But for the most part, the accounting firm and the CPA are not going to put something there that is just not accurate, and they have not, at the very least, have some backup. So you want to take a look at that. Also, you want to find out the speed or the availability of that information when they provide it to you. I like to ask for the last 3 years of the federal tax returns to the company. I like to ask for the last 3 years of the payroll taxes. I like to ask 3 years for if they're in a retail business. I like to ask for the last 3 years of the Florida sales taxes. It's a Florida business. They have Florida as for the most part, you got to pay sales tax, and there's a separate return that goes along with it. So I like to ask for those sales tax returns as well. In addition, the last 3 years of your bank statements. The bank statements that receive any funds from the company and the bank statements of any accounts that disburse any funds out of the company. So all those, to begin to gather all that information. Because one of the things that information also, if they can provide to you an accountant version of their QuickBooks file, that will be helpful to you because then you can provide that to your accountant. Why do you need this information? Because this is going to be the basis. Then you're going to do more financial analysis. And the financial analysis, and again, this is what your accountant will help you with that. But one of the things you want to look at is basically, for the most part, when I look at business brokers' listings, and again, it's nothing, the business brokers get the information from the sellers, from whoever's selling. So they're not verifying the information. In fact, they tell you that in their listings that we got this information from the seller, you're responsible for doing your own investigation. So you want to make sure that whatever is represented on the listing is closely matched with the information to the due diligence that you receive in the due diligence. Simply because, they said, okay, we make, $300,000 in profit. The company makes $3 million a year in sales. Okay. The owner's retiring. It's just, kind of typical why people are selling businesses. You want to see that it's closely related to that. But also you want to look at the operating expenses of the company. In a monthly basis, what is the amount of revenue necessary to keep the doors open, to keep the lights on? And you need to look at that when you're looking at the financials, and your monthly bank statements will tell you that. Well, at least give you an idea of exactly how much money you need. You also want to look at the cash flow of the company. Is it a service business that, like a consultant, for example, or a consulting firm? It could be that basically invoices on a monthly basis, and then then you receive checks or payments online. So what is the frequency of payments into that business? Is it a retail business that gets revenue every day and maybe over the weekends more or holidays? So the frequency of the revenue and how soon and how frequent enters into the company's account is very important, because that's going to tell you what type of manpower you will need in order to keep that business going. And also your cash flow, whether it's going to be cyclical, whether it's going to be peak in the weekends, all that is important for you to know in terms of determining, okay, so they made this amount of money, but when did they make the money and how frequent the money came in? Because the actual invoices will be due on the due date regardless of when the cash flow comes in. So you got to look at that as well. And your accountant can help you do some analysis and some simulations, but you'll be surprised the number of people that do not look at that. And they look at the yearly revenue, but they don't look at really what happens in the business. You run a business every single day. You don't run a business once a year and then you get paid at the end of the year. So the tax returns is a snapshot, and the purpose of the tax return is to declare to the government, federal government, the money that you earn, what deductions, how much you owe. That's the purpose of that. So relying strictly on tax returns is just not the correct approach. There are other, you want to look what happens on a daily basis in that business, and a weekly basis, what happens at the end of the month, to determine how you got to visualize yourself going in and running that business, how it's going to affect you. And also will tell you the cash requirements after you buy the business. How much do you need as working capital to keep it going, especially in the first few months as you learn, get the learning curve on how to run that business. Number three, the item that I would also ask for is the lease agreement. For the most part, most businesses, unless you're going to buy the building, which is a whole different conversation, you will have a lease. You will have, whether it's an office setting, whether it's a retail location, you will have a lease agreement that you will have to be assigned to you, or you would have to negotiate with the landlord a new lease. So you ask for the copies of the lease agreement. So, and the reason for that is this. So say you're going to buy a business and there's only 2 years left in that lease, or 1 year left in that lease, and there's no renewal option. You don't have a renewal option to work with. So that is a concern, because you basically are going to be in that location, especially the business relies on the local traffic. You need to make sure that you have 3 to 5 years, whatever number of years you feel you want to stay in that location, and take advantage of that goodwill that the prior business owner has generated, has created, and that's where you're buying, the goodwill. So you want to see how many years are left in the lease, and how much the lease cost. And I know I had an episode on lease agreements a few weeks ago. And I'll probably do another one and do a deep dive in the leases. But you want to find out what the lease, and to find out whether, if you already signed a letter of intent, part of your due diligence is also to talk to the landlord. Maybe, and the landlord's going to require an application for you to qualify you financially. But one of the things you want to do is that if there's 1 year left in the lease, you have to negotiate an extension of that lease, or a renewal, or you need to extend, or an amendment to increase the number of years, because you don't want a situation that you buy a business and then 6 months later you get a notice that the landlord's not going to renew the lease, and then you have to leave the premises. So the lease agreement is something that I asked for as well. That's number three. I asked for what personal property, what inventory, what equipment is going to be involved. This is number four. So we call it personal property or property inventory. So what is going to be included as part of the sale? What type of equipment will be included, with the condition of the equipment, and that should be a list of those items as well. The number five, we'll do labor relations documents. This would be you have employees. So I want to have a list of all the employees. I want to have their salaries, and basically I want to have the personal records to review. Clearly, you're going to sign an NDA on this. But you want to have a list of all the employees and whether or not, everybody, what they're getting paid. I want to find out who's going to stay, who's going to leave. Is there a key employee? What do they do? And that's a different analysis altogether. But I want to have that information, and whether or not, how they're getting paid. Are they getting paid through a payroll company, which is very important, because most likely a payroll company has done the proper withdrawals, the withholdings, and they're basically should be paying the payroll taxes. But at the very least, there's a little bit more assurance if you're not a payroll company or the owner is doing the payroll him or herself. So I want to know that. But you should be received that information. Also want to find out whether or not they did the proper verification with I-9s, W-4s. The I-9s, the verification to work in the United States. So I want to take a look at that as well to make sure that everybody's right on the same page. And also whether or not they have independent contractor agreements or anybody who is, quote unquote, an employee, but they're getting paid. The term that the people use is 1099 employee. Does not exist. It's no such thing as that. But they say, well, I just kind of paid him every week, but he has to come every day. That's an employee. So that's, I want to find out if there's an independent contractor, why are the independent contractors? What do they do? Is there an agreement? So for this episode, I'm going to recap the financials. Well, corporate records, number one. They're not in any particular order. All the documents are important, by the way. They're not necessarily more important than the other, but you want to get all of them because all of them have an important role in the due diligence process. So you have your corporate records, your financials, lease agreements, number 3, personal property, number 4, labor relation documents, number 5. In the next episode, I'm going to go over 5 additional category of documents that I believe that you need for your due diligence process, and I'll do a recap and all of it as well. But for now, I think this is good for now. If by listening to me, I like to make you give you an offer as well. I do have a due diligence checklist that I use. This is the one that I use for when I'm representing buyers to buy a business. If you're listening to me today, if you'd like a copy of this, send me an email at richsierra.com and just put in the subject line, due diligence checklist, and I'll send you the copy that I use. It's like 5 or 6 pages long, actually more. It's a very comprehensive list. So I'm happy to send it to you as a thank you for listening to me this morning, and I hope it is helpful to you as well. So how can you reach me? Again, my email is rich@richsierra.com. In fact, I have a brand new website, which is the website for the book is richsierra.com. So take a look at it, see how you like it. If you're interested in the legal services that we offer at my firm, the website is floridasmallbusinesslegalcenter.com. We're on Facebook at FSB Legal. If you like to watch the video in the podcast, we have it out on video. It's youtube.com/@RichardSierra. We're on Instagram at FSB Legal. You can call us at 866-842-5202. Also, the book Business SOS, 8 Common Legal Mistakes Business Owners Make and How to Avoid Them. It's available on Amazon, Barnes & Noble. You can ask for it at your local bookstore. If you like the podcast, I hope you did. I ask you to please follow the show so that way you get the updates every Tuesday when they come out. And also, truly would appreciate if you give us a review. That will also help the algorithm to recommend this show to other business owners as well. Until next week, this is Rich Sierra with the Florida Small Business Legal Center. Remember that my goal is to help you succeed.